Josh, I'll get you to introduce yourself.
I'm Josh Sheluk, Portfolio Manager and Chief Investment Officer at Verecan Capital Management.
We are doing something new today. We do typically send out trade updates in the form of a PDF email to our clients, but we have had some requests to provide them in a different format, and we thought this was sort of a natural fit for us. So the first change that we made was on March 31st, and that trade update was called Out of the Public Eye. We like to have tongue-in-cheek titles for our trade updates. And in this case, you added Starwood REIT and Hamilton Lane Global Private Assets to the portfolio. What makes private investments like these appealing to you right now?
For me, it's less of a right now thing and more of a permanent opportunity in these type of investments. And as we said in the note, there's not a whole lot that's different between a public investment and a private investment. The real key difference is that public investments trade on an exchange where private investments don't. Now, these private investments specifically, they have some interesting characteristics with them. And private equity, which is represented by the Hamilton Lane Global Private Assets Fund, is just investments in companies, but they're companies that don't trade on exchanges. And what we've seen over the past couple decades is fewer and fewer companies are trading on exchanges. More companies are staying private for longer as they get larger and as they have more access to capital and through these private market type of investments. So we thought that as these private markets grow, there's an opportunity there for us to add three things really: a bit more diversification, hopefully a bit better return from something like this by being a bit more selective, and hopefully a bit less risk or a bit more stability in the investments that we have. And the story is much the same with the Starwood REIT. It's real estate specific, is Starwood REIT. And again, it's less about being private or public. It's just that this is an interesting opportunity. We find that real estate's been beat up for a couple of years now, both in Canada and the US. And the US just offers a slightly better valuations or more attractive prices right now. So there's an interesting opportunity there on the real estate side of things where we're looking at something that's a little bit unloved in a market where the vast majority of things have been loved for a long time now. I want to add on the private investments that we made in Hamilton Lane and
Mhm.
Starwood. We've done more due diligence on private investments in the last 12 months than we've done on any type of investment that we've ever done, and rightfully so, because these private investments come with some nuances and some extra stones that you want to turn over just to make sure that you're looking everything. We probably looked at, I'm going to say, 2 to 3 dozen different private investment companies and a variety of different private investments from those companies, and we landed on these two. So we're very comfortable and confident with the decision that we've made. It came with a lot of thought, a lot of work, a lot of time and effort from many people on the team to make this happen. And we're excited about that.
And in another trade update recently on April the 3rd, entitled Leaning into Uncertainty, you added positions in Skechers, Lululemon, and Shopify. What made these companies more attractive right now?
Well, significant declines in their prices is the short answer for it. Tariffs were introduced, Liberation Day happened, and these companies were especially affected from those announcements. And for somewhat good reason, they're consumer businesses that have international trade at the core of their businesses. So it makes sense that the knee-jerk reaction was to really punish these companies' stock prices. But if you take a step back and look at it with a bit more of a patient eye and understand that you're valuing these businesses based off of the entire future of their profitability, then you start to question, should these stocks be down 15, 20, 25% in one day, tariffs or no tariffs? And where we already saw fairly attractive pricing for them before tariffs were introduced, we thought that there was very good upside for these businesses. If you take a 20% discount off of that price that was already attractive, now we're starting to get a little bit excited about where these things can be. I'm not going to say in the short term, but when you look out 3 to 5 years, which is what our time frame is for investing in stocks, we find these to be pretty appealing opportunities.
Thank you. One easy lobball question for you is, in the face of tariffs and uncertainty, what role does diversification play in your overall strategy?
Well, it's absolutely crucial to what we do because this may be shocking to listeners, but we didn't have any real crystal ball as to what was going to happen with tariffs. We were surprised to some extent, just like everybody else, to the extent and severity, we'll call them, of the tariffs that were introduced. And without the ability to predict those things, diversification helps reduce risk. It helps us spread around our ideas, our investments to make sure that we're not too exposed to any one outcome. So the fact that we're so well diversified, different countries, different sectors, no company, no one company makes up more than about 1.8 or 2% of our investment portfolio. The fact that we have that diversification means that whatever turmoil we're going through, whether it's a pandemic, a war, an inflation crisis, or now a tariff war, we're going to come out on the other side with a set of strong companies. Some will do better than others, but on the other side, we'll be okay and we'll be positioned to regain our footing on the growth side of things.
Great. Thank you so much, Josh, for your time. I know you have a busy day, so I'm going to let you get back at it, but thanks so much.